नमस्ते दोस्तों। मैं हूं अंकित कानोडिया, स्मार्ट सिंक इन्वेस्टमेंट एडवाइजरी सर्विस से। हम लोग एक सेबी रजिस्टर्ड इन्वेस्टमेंट एडवाइजरी फर्म है। और आप लोग का सबसे पहले शुक्र अदा करना चाहूंगा कि आपने हमारे यूट्यूब चैनल में काफी वीडियोस को देख के काफी उसकी सराहना की है। और कमेंट्स में आप बताते रहते हो कि आपको क्या अच्छा लगता है, कहाँ पे हमें इम्प्रूव करना चाहिए। तो लास्ट मंथ हमने एक बहुत पुरानी वीडियो हमारी शेयर की थी, जो कि रिटर्न ऑन इक्विटी के ऊपर एक प्रैक्टिकल केस स्टडी बेस्ड वीडियो थी। तो बहुत अच्छे कमेंट्स आए और बहुत लोगों ने हमें ये रिक्वेस्ट किया कि हम ऐसी वीडियोस और बनाएं और शेयर करें। तो जैसा कि हमने बताया था कि ये वीडियो 4 साल पहले की हमारे मिशन स्माइल प्लेटफॉर्म, जो कि एक एजुकेशनल इन्वेस्टमेंट एजुकेशनल प्लेटफॉर्म है, उसका एक वीडियो था जो हमने लास्ट मंथ रिलीज किया था। और हमने फिर बेस्ड ऑन जो कमेंट्स हमें मिले थे उस वीडियो के, हमने ये प्रॉमिस किया था कि हम लोग कोशिश करेंगे कि हर महीने हम एक ऐसी वीडियो भी रिलीज करें, जिससे खास करके नए इन्वेस्टर्स को प्रैक्टिकल एस्पेक्ट्स ऑफ दीज फाइनेंशियल कंसेप्ट्स क्लियर हो जाए। तो इस वीडियो में हम लोग बात करेंगे पी रेशियो की। अगेन, ये याद रखिए कि ये 4 साल पुरानी वीडियोस है, तो इसके एग्जाम्पल्स जो होंगे 4 साल पुराने होंगे। लेकिन अगर आप वो वीडियो को ध्यान से देखते हो तो आपके लिए आज भी बहुत रेलिवेंट है। कोई भी चीज़ ऐसा नहीं है कि आउटडेटेड है कि आपको कुछ काम का नहीं होगा। तो पेपर पेंसिल लेके बैठिए, नोट्स बनाइए और ध्यान रखिए। जैसे कि आज मार्केट गिर रहा है, आप देख रहे हो कि कितने ज्यादा वोलेटाइल मार्केट है, कितने स्टॉक्स 40-50% गिर चुके हैं अपने ऑल टाइम हाई से रिसेंटली। आपने अगर नोटिस किया होगा तो ऐसे मार्केट में भी कुछ स्टॉक्स है जो हाई पी रेशियो के बावजूद भी ज्यादा गिरे नहीं है, और कुछ स्टॉक है जो बहुत ही कम पी रेशियो पे थे, बट उसके बाद भी बहुत गिर गए इस करंट वोलेटिलिटी में। इससे हमको एक प्रैक्टिकल लर्निंग ये समझनी चाहिए कि हाई पी रेशियो इसका मतलब ये नहीं होता है कि स्टॉक तुरंत में गिर जाएगा, और लो पी रेशियो का मतलब ये नहीं होता है कि स्टॉक यहां से गिर नहीं सकता। थ्योरेटिकली हम लोगों को लगता है कि पी रेशियो कम हो तो अच्छा है, और पी रेशियो ज्यादा हो तो खराब है। लेकिन देर आर मेनी एस्पेक्ट्स ऑफ पी रेशियो विच गेट्स इनटू स्टॉक। कंपनी के बिजनेस कैसा है, ग्रोथ कैसा है, इंडस्ट्री जो है उसके ऊपर में जनरली मार्केट पार्टिसिपेंट्स के क्या व्यू है। ऐसे बहुत सारे फैक्टर्स है। इनफैक्ट मैंने 7 फैक्टर्स को इस पे कवर किया है इस वीडियो में, तो आप ध्यान से देखिए। और ये एक अच्छा समय है जब मार्केट गिर रहा होता है और आप कंफ्यूज होते हो कि क्यों इतने स्टॉक्स गिर रहे हैं। तो आई थिंक ये वीडियो अगर आप देखते हो ध्यान से तो आपको काफी अच्छा आइडिया मिलेगा कि पी रेशियो को हम लोगों को किस तरह से यूज करना चाहिए प्रैक्टिकली हमारी इन्वेस्टमेंट जर्नी में। आशा करता हूं कि आपको ये पसंद आएगा। थैंक यू।
Good evening, everyone. Thank you so much for joining for our second chapter of Triple S की Pathshala. Uh, as we mentioned in our teaser, it will be about P ratio. And the main question we are trying to answer through this webinar is P ratio actually relevant today or not? The reason we have chosen this topic is there have been different views about P ratio. Some say that it is completely irrelevant. Some still base their decision only on P ratio. And that is what we are trying to cover in this presentation. Okay. So we start with this very good quote by a famous author, Rory Sutherland. Opposite of a good idea is also a good idea. Okay. So what is one good idea? Charlie Munger, who is a very celebrated legendary investor based out of US, he talks about an investing style which is known as surfing, wherein he says that when you see something new happening, whether it is breakthrough technology or any other thing which is something which is new and has a long future, it makes sense to catch it young and just bet on it as if you are like a surfer, like how the surfer used to surf in the ocean by just staying along with the stuff they have in their hand, right? So that is what uh, Charlie Munger says that in investing, it makes sense to go through that kind of an investing style. When you adopt a investing style like this, what inherently it teaches you is that you should be able to ignore the temporary overvaluation of the businesses which you are holding, because ultimately any good business which is a new and small business, and you believe that this is something which is going to be a breakthrough technology or something which has something really new, you got to see their valuation in terms of P ratio or price to sale ratio going really high, right? But that doesn't mean that just because it is high, you will sell it and then look for other investment opportunities. So that is what Charlie Munger says. And what is idea number 2? This is a completely different idea. Over here, again, another legendary investor, Howard Marks, he talks about the cyclicality in the field of business and investing. So he basically says that everything is cyclical, right? You can't bet on anything and just buy and just believe that if you just hold on to something, you will be able to make a lot of money. You should always pay attention to the value. So his mantra in short would be buy low and then sell high, right? Whenever there is a overvaluation in whatever asset class you are owning, you should try to sell that and then try to invest in that asset class where you find more value, right? So these two ideas, we wanted to start with these two ideas and try to keep these two conflicting ideas in your mind while we run you through the presentation. I think that would help you form a better opinion after the presentation is over, because P ratio in a way captures these two ideas in several ways. So this is going to be the agenda of today's webinar. We'll start with a few examples. Then we'll share our learnings. We'll quickly run through the P ratio formula. We will not spend too much time on that because that is something which all of us know, and that is something which is available on the internet as well. But we'll spend more time on other things like factors that drive the P ratio, at what P ratio should one buy and at what one should sell. Is P ratio actually relevant today? How to use P ratio effectively? And then our concluding thoughts on P ratio. So we are trying our best to make it more interactive and include a lot of real examples in terms of company names. Let me put a disclaimer first. We may or may not be holding some of the companies. So please don't take it as a recommendation. But it's the whole purpose of this SSS Pathshala, as the name suggests, is to just share our learning and learn from our own mistakes and our own experience over the last 8-10 years in the stock market, right? And we would love to have your questions. You can keep pouring in your questions on the chat box. We might be, we'll take up all the questions after the presentation, but you can keep on typing your questions on the chat box, because sometimes it happens that you wait for the last time and you forget your question. So don't bother about that. Immediately type your questions whenever it comes to your mind. Okay. So with this, let's look at some of the examples. So this is P chart of a company named PI Industries. Okay. If you see, right from 2013-14 onwards, it has been basically almost all the time above 30 times earnings, right? And only for a brief period in February and in 2018, you would have witnessed the valuation coming down to somewhere around 20 times earnings, right? Even 20 times earning in traditional way would not be qualified as a very cheap or very attractive price level, right? But still, this is a company which uh, which basically is into agrochemical. And if you look at the screen, bottom part of the screen, you will see why this company has consistently traded at a higher multiple is it has been able to consistently grow its sales, profits, and the ROE has been always uh, be very healthy. So it is more than 20% over the last 10 years, right? The second one is Eicher Motor. You see how the P ratio has been all over the place in the last 10 years. And this is one stock which has been a 100 bagger in the last 10 years. Even then, you see how volatile the P ratio is for a company like Eicher Motor. So in February in 2010-11, it was available at a P ratio of around 10 as well. And at one point of time, the P ratio shot up to levels like 80 also, right? Even today, it is more than 50 times earnings, right? And if you look at the performance of the company in terms of sales and profit growth, the sales growth has not been that great in the last 2-3 years, right? The sales growth has been it. See, these blue blocks are basically EPS. So you can see from 2010 till 2019, the EPS continued to grow at a very healthy rate. And then after that, it tapered off, right? The third stock is Relaxo Footwear. It is today trading at almost 100 times earnings. And we might scratch our head and try to find out how to look at a company like this and how to invest in it. But even a company like this, if you look at the history, the main reason for the stock to do well is you can see the sales and profit growth has been so consistent. And just look at these blue buildings. Consistently, it has been rising. So the earnings growth, which is 27% CAGR, that is a huge thing. Very few companies manage to do that. And that is why it is trading at an obscene, it appears to be an obscene valuation of 100 times earnings, right? So it was expensive even in 2015 when it was trading at 60 times. But even from there, it has been a good wealth generator for investors. Then there is Asian Paints. Interestingly, in case of Asian Paints, you don't see the sales growth or profit growth to be that high. So if you see, the sales growth has been 11% and the profit growth has been 14%. So it has been a steady grower, but the kind of ROE, the kind of P it has been commanding, it is simply incredible, which is close to 100 again, right? So in case of Relaxo, we saw that the earnings are increasing at a very high rate. But in case of Asian Paints, that is not the case. But still market is valuing it very expensively, right? Then there is Bajaj Finance. Of course, Bajaj Finance is a financial company, and a right metric to understand a financial company would be price to book. But just for the sake of understanding and comparison, we have seen the P ratio of Bajaj Finance also. So even this company today, it is trading at its all-time high P ratio. One reason for that could be the earnings post the pandemic has been not so good for any banks. So they all had problems in terms of loan growth and all. So that is why the earnings are probably even today not normalized, but some sort of a depressed earning. And that is where you see a higher P ratio for them. But if you look at the numbers, these are mind-boggling numbers. 5 years CAGR of sales is 30%. And in case of profit, it is 28%. So
One
very,
question.
very, very. Yogesh, you can, yeah,
Type.
please go ahead. Please go ahead.
Okay. I'm asking, like, when you're saying like earnings, it means profit, right? Or
Yeah, earnings means, yes, when I say earnings, it is basically EPS, earnings per share. Yeah.
but if we see the chart, EPS is growing, but why then P is not coming? Because price is very high, is it?
Just a second. So if you see, uh, in June 2019, the EPS was the highest. See, in 2019, the EPS was highest, and then it started falling. So the EPS is falling, but the price is high. That is why the PE ratio has gone up significantly.
Oh, okay.
So that was about Bajaj Finance. Now look at ITC. ITC at one point of time, it was trading at 45 times earnings. And in the last 1.5 years, it has been mostly trading between 15 to 20 times earning. If you ask any investor who has been investing in stock market since 1990s, or maybe in the decade of 2000 to 2010, or even in the last decade, uh, it is puzzling. It is puzzling to see ITC being traded at such a low valuation. But if you look at the numbers, they say a lot of the they show a lot of the things, like you see that sales and profit has not grown the way it was growing in the early part of the of last decade, right? And even though profit growth of 10% CAGR is not bad, but the kind of expectation people have with a company like ITC was probably not met, and that is where market has punished the stock. So what can we learn or infer from all these examples? So these were some of the points which we could identify. So P is predominantly driven by earnings expectations, right? So why I say earnings expectation and not earnings? Because expecting earnings need not always be same as actual earnings. So like in case of ITC, you see the earnings are growing. If you look at 2018, 2019, 2020, it's not that the earning is not growing. Earning is still growing. You see the EPS bar, it is rising, right? But still the market is not giving it, because the market was expecting a much higher earnings. Similarly, in case of Asian Paints, even though the earnings have not come, if you look at the last 10 years earnings, they have not grown at a very high rate, but market is giving it a premium valuation, because market still expects that maybe in future the earnings will further accelerate from here on. So that is the expectation of earnings in case of Asian Paints. We are not saying you should buy Asian Paints because the P ratio is high, and we will not say that you should not buy Asian Paints because the P ratio is very high. What we want to project over here is that Asian Paints earnings, the P ratio doesn't signify the actual earnings. They signify the expectation the market is having about their future earnings, right? I think someone asked this question of what leads to the expectation. We'll cover that in the subsequent slide. You will be able to know about that. So earnings is that matters the most. So if you look at companies like Relaxo and P in the examples, the reason they have commanded really good earnings is a really good P ratio is they have consistently grown their earnings. Relaxo and PEI Industries, both are completely different businesses, but and they have different strategies. In case of Relaxo, they focused on they have a focused business wherein they are making only shoes and slippers and shoes, and they are just benefiting out of the brand and also the unit economics, right? But in case of PI Industries, They keep on adding to new businesses and new verticals. When the domestic market was not doing well, they were focusing on the export market. Now they are also going into pharma. So they keep on finding new areas of business from where the growth will come. So that is how they have consistently grown their earnings. Now, at 100 times PE of Relaxo, or at 60 times PE or 70 times PE for PI Industries, an investor should look at them and try to say, as in try to figure out whether this is possible to continue, and do we have the margin of safety here or not. That is the question which an investor needs to answer, right? So earnings, in case of earnings, the more the better, the steadier the better, and the highest growing the best. So in case of Bajaj Finance, we have seen in the last 5 years, they have grown their earnings crazily by, say, something around 25 to 30% CAGR. That is where the stock's valuation has always been on the higher side. If there is any doubt in future earnings, market punishes the stock, like the example we have seen in case of ITC. Now, ITC is trading at a very reasonable multiple because market today expects that, probably our assessment is, market today expects that since they are using most cash of the cigarette business in growing their FMCG business, and the FMCG business may take a lot of time to turn profitable and throw out a lot of cash flow. That is where market is skeptical about the stock. Now, if you want to buy the stock at this valuation, you will be betting that this is something which is a very temporary phenomena. You expect the earnings to continue to grow at a healthy rate going forward in the next 2-3 years, and you are getting a good quality business, good quality management, a company which has got a 100 years track record, and you feel that there is a very limited downside. That is how you look at the stock like ITC. But that doesn't guarantee that your expectation of earnings will meet in case of ITC. It may well happen that ITC continues to invest heavily in the FMCG business, and in the next 4-5 years, you might not see any cash flow coming in, right? So what is P ratio? We all know. I'm not going to read out everything. So it's just in a simple way, price divided by earnings, or what is the current market price, dividing it by the EPS, you get the P ratio, right? Now, when you look at all these things, 7 factors which drive the P ratio, I think someone asked one question about how the expectations are, how to see the expectation. I think that question will be answered when we look at all these factors. So number 1 factor is earnings visibility in the long run. We'll cover all these 7 factors in detail. I'll just put all these first. Second is potential of earnings growth. Third is return on equity. Fourth, the level of debt on the balance sheet. Market's view on the industry or the company. Dividends the company declared. And finally, interest rates, the prevailing interest rates in the market, right? So we start with the first factor, which is earnings visibility over the long term. So any business which is having stable demand will consistently trade at a higher multiple compared to any business which is cyclical. So we are not trying to say that HUL at 100p is an attractive buy, and Bajaj Auto at say 20-25p is not an attractive buy. What we are trying to say over here is both these businesses are completely different. A Bajaj Auto has a cyclical factor, wherein if you would have observed since late 2016, the auto sector, specifically the two-wheeler sector, went through a downturn, and it it showed up in the balance, it showed up in the numbers of not only Bajaj Auto, but all the two-wheeler companies in the country. But in case of companies like HUL, we know that they sell consumer products, right? They say they sell products which have a daily demand, which is not going to die down anytime soon for a country like India because of its demography. So it is easy to understand this fact that at any point of time, there is a higher chance that HUL, a stock like HUL, would be trading at a higher multiple compared to a Bajaj Auto. And the way you will look at or forecast or try to make sense of the valuation of HUL will be completely different from how you will analyze the valuation of Bajaj Auto. Because in case of Bajaj Auto, you have to understand where in the cycle you are. But in case of HUL, you know that if you take a 5-year view, 10-year view, you know that in India, you will see that volume growth happening in the products which they are selling, right? The second point is potential of earnings growth. So if you just go to screener and see, Castrol India has an ROE of 70%. And this is not today's ROE, it is last 10 years average ROE. Bajaj Finance has a far lesser ROE compared to Castrol. But what has led to a stock like Bajaj Finance to be a multi-bagger and Castrol being, Castrol is a stock which has given zero return in the last 10 years. Because Bajaj Finance is a company, of course, these are two different, these are in two different sectors, and it is not an apple-to-apple comparison. But the point we are trying to make through this example is, until unless you are a growing company where your earnings are consistently growing, you cannot command a higher multiple for a long period of time. And that is why Castrol is trading at a very, I think it is around 8 times earnings or 9 times earnings today, right? And in case of Bajaj Finance, we have already seen how the multiples have shot up, right? The third one is return on equity, wherein we have already covered return on equity in our first chapter of SSS Pathshala. The recordings are available for all the participants, and even people who have joined this one for the first time and they want to look at the recording, they can still go for the recording. So where we have explained in detail how to analyze ROE of a company or a business. So in case of ROE, you can see in case of Nifty, you see there is a company like ONGC also there, and there is a company like Nestle in the Nifty. And you know how the difference in valuation these two companies have. And the sole criteria of that kind of a difference is the ROE. Nestle makes up an ROE of somewhere around 50 to 60%, right? And they efficiently manage their capital. But ONGC is a company which is not being able to generate even enough returns on their capital. So that is where the market's expectation on the growth of that business is far lesser. Now, when we are saying this, we are not saying that you should not buy Nestle, you should buy Nestle and not buy ONGC. See, markets are always cyclical. So if there is some cyclical recovery happening in case of the oil and gas sector today, it might make sense for you to buy ONGC, but only if you understand the business well and if you can forecast and foresee the earnings really doing well over the next 2, 3 years, 4 years, and then you make sense, and then it makes sense for you to buy ONGC today. But one thing is for sure, if you take a longer term view, say 10 years or 15 years, it is easier to bet on a company like Nestle than to bet on a company like ONGC. Whether to buy Nestle today or not, that's a different matter altogether. The next point is, next factor is debt. Market always value those companies more which has a debt-free balance sheet. That is where, if you would have seen over the last 1.5 years, those companies which were heavily debted and they deleveraged their balance sheet in the last 1 year, they were rewarded really well in the market, by the market, right? So deleveraging is a theme which many times work in the market, because market really likes this fact that the promoter of the company is thinking about making the business more efficient, reducing the debt, improving the earnings, improving the strength of the balance sheet, and that is how market rewards those companies. But there are companies like, in case of Power Finance, you'll see the debt equity ratio is 11 times, and it is trading at a P ratio of 3 times. Whereas a company like CRISIL, which is a zero debt company, there you see the P ratio is 56. You can say that Power Finance is in a different sector altogether, CRISIL is in a different sector, but you can see the same thing in case of Britannia and Nestle also. We covered Britannia and Nestle in the previous session as well, where you would have seen that Britannia uses debt very effectively, right? And Nestle doesn't have any debt in its book. It keeps on giving back a lot of dividends to its shareholder. So that is where Nestle always have a higher ROE, will always have a higher P compared to Britannia, right? Even though both are into the same sector, both are having dealing with products which are having really good consumer demand, but still you will always see Britannia trading at a discount to the valuation of Nestle. The next one is market's view on the industry. So if you look at the history of Indian stock market, cement companies in the 1990s, infotech and media company during the late 90s and early 2000, the real estate and construction sector during 2003 to 2007, and chemicals and FMCG in the last 10 years, right? These are some of the industries where market has caught a lot of fancy, and people have, I mean investors in general, have thought that these companies have something really special, and that is how they started valuing this company at obscene valuation, or at valuation which was never seen before. And history always gives us an indication that those kind of valuation do not sustain after a period of time. So now there is a question which comes to everyone's mind that this might not work in case of FMCG, because in case of FMCG, we know that the demand is still going to be there in the next, say, 10 years or 15 years or even 20 years, right? So why will FMCG's valuation correct? So that's a fair point. FMCG continues to have a very good demand, and what may happen is you will not see a price correction in case of FMCG stocks, but you may very well see a time-based correction, because ultimately capital moves from inefficient businesses to efficient businesses, or market is a self corrective mechanism, wherein wherever there is a high valuation, the money will shift from that area of the market and go to the area where the valuation is far more attractive, right? We have seen that happening in case of a lot of cyclical companies in the last 1.5 years doing really well. That is how things work in the market. It's just that since we have seen the last 10 years where the cyclicals didn't do well, in general, people become skeptical of that when those companies start doing well, right? And in terms of valuation, like in case of Infosys, we can understand, we can take the Infosys example. At one point of time during the infotech and media craze in the market, Infosys was trading at a multiple of 200x in terms of earnings, right? And today, even if you look at the performance of Infosys in terms of their sales and profit growth, it has been a phenomenal business to own. But still today it is trading at 35x. So what does it say about Infosys or a company like Infosys? That in 2000, probably market uh, did not see or provided it the multiple which was not worthy of the kind of growth it was going to produce in the next 10 to 20 years. And mind you, these 10, 20 years growth of Infosys has not been an average growth. It is on an average, it has been between 15 to 20% sales and profit growth, which is done by very few companies in the country. So despite that kind of a growth for 20 long years, you have seen the multiple going down from 200x to 35x. Why can't it happen in case of FMCG is the question we should think about. It may not happen the exact way because FMCG and IT businesses are completely different. But just because it's an FMCG business, just because it has a lot of demand, perpetual demand, doesn't guarantee a company to sustain a P ratio of say 100 or 150 or 200. It may come down once the market participants realize that the growth is not coming as per the valuation it is demanding. And more importantly, when the market participants see that there are other sectors, other areas of the market where there is more demand and where you see a lot more growth happening. So that is how the market's view on the industry can have an impact on P ratio. Dividends. Our assessment is that people don't understand the real concept of dividend in investing. Most investors, when they talk about dividend or how to earn high dividend, they talk about high dividend yield stock, right? But what is more important is how much dividend, total dividend or absolute dividend a company is sharing or declaring year after year to its shareholder. That is what it matters. And how can a company provide or declare more dividends year on year? Only if it can increase its earning. So that is where an investor should always look at whether the dividends are sustainable, consistent, and steadily growing or not. Because there are companies which will be very erratic with their dividend policy. In good times, they will offer really high dividend, and then in the bad times, they will not have any money, excess money to even give any dividend. So those are not the companies where you can bet on the dividend. Best dividend paying companies are those companies where maybe the dividend yield is not so high, but you see that the company continues to make a steady growth in earnings and they consistently pay a higher dividend payout, right? And that is where you earn as an investor through dividends, right? So dividend, when you are analyzing a stock or analyzing a business, pay more attention to dividend payout than dividend yield. So just to give you an example, in the last 10 years, again, no recommendation, just an example. In the last 10 years, you would have seen Coal India being available at a very attractive dividend yield, specifically from 2015 till 2021 today, right? And Nestle didn't have that kind of a dividend yield. Its dividend yield was less than 1%. But had you put in the same amount of money in both the stocks in 2010, you would have made more money in Nestle through dividend because the earnings kept on growing and you got more dividend year after year, right? The next part is, and the final one is interest rate. So basically any business, the thumb rule or the main rule of valuation is any asset class, not just equity, anything, any asset class is worth the amount of cash flows that asset can generate over its lifetime and then discount it through a risk-free rate. That is how any asset class can be valued. And as we see today, we are living in a world where interest rates are continuously falling. It is fair to assume that in these kind of environment, the multiples or the P multiples will continue to be on the higher side. Only when you see the interest rate hardening, you will see the P multiple contracting. So now putting all these 7 factors together, you'll see, again, if you just look at the 2 nifty stocks, ONGC and Nestle, Nestle scores really good marks in all these 7 points. And similarly, ONGC doesn't score well in that, in most of the parts. So it does pay a good dividend, but and interest rate is same for all, both ONGC and Nestle. But ONGC is having debt on its balance sheet. The market view of the industry in the last 10 years, 11 years has been favorable for Nestle, not so much for ONGC. Return on equity, again, Nestle has been much better. Potential of earnings growth even from today, if you take a longer term view, in the short term, maybe ONGC may get a higher growth in the next 2-3 years because of the changes in the oil prices and the way the sector is now reviving. But if you take a 10-year, 20-year view, again, Nestle is far ahead than ONGC in terms of growth prospect. So these are the reasons why a company like Nestle is trading at a higher valuation and a company like ONGC is trading at a lower valuation. So if you put these 7 factors in mind, you would be in a much better position to judge whether this P ratio of this company should be on the higher side or on the lower side. So the next question is, at what P should one buy and at what one should sell, right? So again, just compare these 2 companies chart. One is the ITC and the other one is Eicher Motors, right? Both have good strong track record, but look at how volatile the P ratio is. So when you look at these charts, you can completely, you should admit that it is impossible to predict the P ratio in the short term. You cannot predict how long the P ratio can continue to rise and when it will start falling. Nobody could predict that ITC will see a P contraction after 2015 and 16, right? Similarly, in case of Eicher Motors also, nobody could see that kind of a fall. And then again, after that fall, again, it has risen so much in a short period of time, right? So what do we learn from all these things regarding P multiples? So forecasting P multiple is next to impossible when you do that for say a short period of time specifically. So rather than focusing on forecasting P multiple, we feel it is much more important for us to try to answer these questions as to how do I see the earnings growth from here on in the next 2, 3, 4, 5 years? What are the risks for those earnings growth to happen? Does the current valuation or the current multiples overestimate or underestimate the growth in earnings? Like in case of, say, again, just for the sake of example, we can again debate on ONGC and Nestle. So maybe market today is underestimating the growth in case of ONGC, where it may get benefit from the cyclical upswing of the industry, right? I'm not saying that it is going to happen. It's just that we are thinking that it may happen, right? Similarly, in case of Nestle, we may say that market is probably overestimating the kind of growth path for the company because in the last 10 years, because cyclical businesses were having a really tough time operationally. So the money was going into safe and steady compounders because you knew that you get the earning stability there. And during the start of the decade, the valuation of these FMCG steady companies were not so high, which they are today. So maybe there is a case of over estimating the earnings potential in case of these companies and underestimating the earnings potential of companies like ONGC, right? The last question we can ask is what can potentially change the perception of investors? So that is a very important question. So what will change in case of ONGC? When you see the company getting really good growth in earnings, or there are some sector tailwinds which will keep on validating your thesis that, okay, now the earnings are going to see an upswing. That is where the P will re-rate. And on the contrary, in case of companies like Nestle, when you see that there are many other options like ONGC or any cyclical companies in the market where you see in the next 2-3 years, the earnings growth in those companies would be much higher than a company like Nestle, you would tend to focus more on buying those companies than Nestle. So we are not arguing that you should sell Nestle and buy these companies. What we are trying to say is that this is how the market moves in short term, right? And again, answers to these questions are not perfect or accurate at any point of time, right? However, they prepare us for making better investment decisions, right? So you may be thinking that if P cannot be forecasted, does it really matter? So you cannot treat P ratio as the only base for thinking about buying or selling a stock. I think Yogesh made this point before we started the presentation, and we agree with Yogesh here that P ratio cannot be the only base for thinking about buying or selling a stock. So it is much easier to think about the earning trajectory. Of course, nobody can predict the earnings with accuracy, but there is far better chance of looking at the earnings direction than looking at the P direction. Because P can, as we have discussed earlier, P can vary because of several factors which are not in our control or in our assessment. Rather than that, if we focus on earnings and try to see whether these companies have a better earning potential or there is some change which is happening, then we are in a much better way to predict the future of these businesses, right? Another thing which we have learned through several examples we have discussed so far is that over a 10-year long period, you will see that the P distribution can be a broad range, something like 10 times to 80 times. So just imagine for any company which can see a P ratio of 10 times and also see a P ratio of 80 times, you cannot predict it with certainty when you will be able to get that stock at 10p and when you will be able to get that at 80p, right? So betting on the value of P is extremely difficult. But does that mean P is irrelevant? We don't say that P is irrelevant. We just try to say that it's just too hard to predict and project. So how can we then use the P ratio effectively? So we tried our best to give you 3 ways how you can solve this problem of P ratio. Of course, we don't claim that these are the best way and these are foolproof, but hopefully you would appreciate that these are much better way of looking at investing, because in investing there is nothing called black and white. Most of the time it is gray, and that is how we have to arrive at a solution. So for 3 ways you can solve this PE problem is, if you are investing for a max 2 to 3 year horizon. So say for example, you are betting on cyclical companies. or even if you are not betting on cyclical companies, but companies that have a long history of track record, what you need to do is in case of analyzing them is you should look at the last 10-15 years of P, and if you are getting those companies at a lower band of P and you believe that these companies are not going to go out of business and the 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 compression of this P multiple has happened because of a temporary problem which is solvable, then you can bet on these companies. A very good example would be betting on a few travel companies during the COVID time, right? So the earnings were not there and the market punished those stocks. So we are not betting there. So when, as an investor, when you invest in those companies, you're not betting on those companies to do really well for long period of time. But what you are betting on, you are betting on mean reversion, right? You are betting on that market is probably very pessimistic about these companies today. But if I buy today, even though there is a lot of uncertainty, I don't know when travel will resume. But since I'm getting a very good bargain, let's buy it now, right? That is one way of looking at P. The other way is when you have a horizon of 5 years or more, of course, you should try to buy at a conservative P based on the industry and business track record. But you should hold the stock until you see evidence of earnings growth tapering off. So again, we would like to discuss the PI industries example here. Like if you see enough, again, let's clarify that it is not a recommendation, but how you should approach a business like PI industry if you are already invested in that company or holding those stock is, you should not base too much, give too much value to the P ratio today. Rather, you should focus more on the earnings growth. Because if you see the last 3-4 years, the earnings have grown really at a high rate. And that is how the P ratio has always looked expensive when you compare it with the trailing earnings. But since the projected earnings are much better than the trailing earning, the stock has maintained its P ratio. Now, you should be willing to hold a company or a stock like this if you see enough evidence that the company is doing taking all the right steps to give you that comfort of earnings growth in the future as well. Only when you get skeptical about the earnings growth vis-a-vis the valuation which it is commanding, then you should think of selling that stock. And the last one is the most basic and the most easily followed way of investing in market. But to follow that kind of an approach, you have to first admit that you don't want to base your decision based on valuation. And that is something which is which sometimes hurts the ego of all investors like us. We think that we know about valuation and why we want to buy in SIP form. I'll buy more of those stocks which are cheap and I will sell those stocks which are expensive. But our view is that it is much better once you have done the analysis of business, analysis of management, and say if you have come up with 20 or 25 stocks which are there in your radar where you want to invest in them. Our understanding says that you are much better off to keep on investing in all those stocks in an equal proportion, month on month in an SIP form. Some would be trading at expensive valuation, some would be trading at reasonable valuation. But if you just focus on the earnings trajectory of those businesses and management pedigree and execution, you are going to do much better as an investor. Just to give you an example, we have talked about Infosys. It was trading at 200 times earnings in 2000. It is today trading at 35 times earnings. there's a joke on Infosys which does a lot of which creates a lot of buzz, where if you would have bought Infosys at 2000 in the year 2000 and held on for 8 years, you would have made no money. But what we forget to observe in those periods is that even if you had started at the topmost price of Infosys in the 2000 mania, and you just kept on investing an equal sum of money, buying Infosys every month, you would have made a CAGR of 13% in those 8 years, where just buying and holding the stock would have created zero returns. Had you done an SIP of an obscenely priced stock, where the earnings growth were continued to do well, you would have earned more than 13% CAGR. So that is the power of earnings, and that is the power of SIP. We don't, even after so many discussions and so many webinars or so many videos which we see today on the power of compounding and the power of SIP, we very strongly believe that it is still a very underrated way of investing, and more and more investors should probably look at it. Now with this, we come to the end of our presentation, and we would like to leave you with these two thoughts. So at one point in the Intelligent Investor, Benjamin Graham, who is regarded as the father of investing, he says that you should not buy stocks which have a P ratio of more than 13.3, based on the bond yield of 7.5%, which was trading at that point of time in US. Even if you look at the bond yield in India today, it would be somewhere between 5 to 6%. So that means Benjamin Graham would say, and if you are a follower of Benjamin Graham, you would not buy any company which is having a P ratio of more than 16, right? But that is not how investing is done, and that is not how life moves. So we are all part of evolution. Since life evolves, investing also evolves. There is so much happening in the investing world today, which was not happening at the time this book was written. We don't want to demean the work which Benjamin Graham has done. It is not that we are trying to criticize him. We really respect his words. What we are trying to say over here is that the world has evolved over the last several years, several decades, in fact, where from the time when this book was written. So how do you live in this world? How do you invest in this changing world? That is where I think this thought of Osho is worth looking at, wherein you will have to create the path by walking yourself. The path is not ready-made, lying there and waiting for you. It is just like the sky. The birds fly, but they don't leave any footprints. You cannot follow them. There are no footprints left behind. Similarly, as an investor, you cannot follow the footprints which you have seen in case of the past way of investing. Today, as we are having this webinar, there is a lot of buzz going around regarding the Zomato IPO. We clearly see that the market is divided in two parts. One part says, which people who are still bent on the traditional way of investing, they say that these kind of companies which are not making any profits, you are better off not investing in them. And then there is another part which says that these are the companies which are going to give you a lot of growth, and these companies are growing really fast, so you cannot afford to miss it. We are not in either side. We are somewhere in the between, where what we want to see or what we want to observe is that startup space is really interesting and really valuable. It does add a lot of value to our society. And if you look at startups like Uber, Ola, Zomato, Swiggy, you can't dismiss them by saying that they are not valuable just because they are not making profits, right? Because they have actually captured a lot of market, And today, they are an integral part of our life. So you cannot dismiss them by saying that just because they are not making profits, they are not valuable. It's just that it is extremely hard to value them. That is where, as a keen observer, as a keen learner, it makes sense to see how these companies get listed on the market, how the market react to it. You may or may not buy, but you should pay attention and see, because the market is going to change. Market is going to evolve. And only after a period of say 3 years, 4 years, when we see a lot more IPOs of startups like Zomato, like we see that Paytm is also coming up with an IPO, then only we'll be able to make sense. But having a rigid view that these companies do not make money, I'm not going to invest in it, or having an outrightly favorable view is not the way to learn about investing. So with this, we come to the end of the presentation. Thank you so much, everyone, for patiently listening. We can now take up the questions. I'll just...
Yeah, Ankit, we have first question from Amol.
Okay.
It's around 6:22 p.m. If current P is less than the median P, can we say that share is less expensive?
Good question, Amol. So if the current P is less than the 15-year median P, median P, when I'm saying about something between 10 to 15 years or 20 years, it does give you a indication that market currently is valuing it much lesser. But that is not the only thing. What you need to do is, need to check is, do you really see the earnings coming back after a time? Like we discussed the travel companies example, right? Wherein if the PE comes really down, so you make a bet that earnings are temporarily down. We expect the earnings to do well over the next 2-3 years. So it is advisable to bet on them, right? But if you see something which happens on a, like in case of a company like Coal India or ONGC in the last 10 years, they consistently fail to make earnings growth. Then just because the market is giving you a P ratio which is lesser than the median P doesn't make it attractive. So your question as your position as an investor should always be, if the market is giving an attractive valuation or a lower P than the median P, is it because of a temporary problem or a permanent problem? And if you reverse this situation, if the market is giving a really high P to a company, is it because of a permanent increase in earnings from here on, or a temporary earnings growth? Sometimes what happens, a cyclical company over the last 2-3 years will see a lot of earnings growth, and market tries to extrapolate those earnings far into the future, which will never happen because it's a cyclical company. That is where you have to check. Just because the market is starting to give them a higher P doesn't make them worthy of investment all the time. I hope, Amal, I could answer your question.
Yeah. Next question is from Kamal. Yeah, Kamal, what sets the tone for the earning expectations?
So, Kamal, so we have fairly covered this point, earning expectation. So, like, just to give the example, in case of FMCG in the last 10 years, what happened? Market saw that all the old economy sectors were struggling, and FMCG sector was the only sector which was consistently delivering some growth rate. That it was not very high growth rate, but it was giving you some sort of an indication that these earnings will continue to do well, right? So that is where an expectation was set, and more and more investors started investing in FMCG sector. And that is how the expectation built on. And ultimately, all the expectations are based on fear and greed. So earlier, people were afraid And that is where they started investing in FMCG, because they thought that you will be secured here. It was not because of getting really high returns. Now, in the last 2-3 years, most of the new investors who have invested in these companies, they have become more greedy, because they thought that these are the only companies which are going to give you returns. So those are the types of expectations people set in by looking at the share prices and looking at how the companies have behaved. Now, it will keep on changing. Like now, if for the next 1 year, you would have already witnessed that in the last 1 year, these FMCG companies, most of these large FMCG companies like Nestle and all these Dabur and all, they have not given exceptional returns compared to some of the cyclical businesses. Now, if this continues for say a couple of years more, then again the cycle will reverse. People will invest more in cyclical stocks and less in FMCG stocks. That doesn't mean that the prices will fall immediately, because as the earnings of FMCG businesses will continue to do at least at a base level, say somewhere around 8 to 10% growth is something which you can still expect. So the market may continue to look at other businesses, and that is where the expectations will change from sector to sector. I hope I could answer this, Kamal. If you have any follow-up question, we can take that.
Yeah, Ankit, thanks. Ankit, but yeah, there is a follow-up question actually.
Yeah.
So so when we say the market, so market is so many players in the market, right? And it's very difficult to ascertain which set of players in the market really set the tone for the expectations. So I understood what you're saying. So earnings, future earnings, say for the FMCG, but then who amongst those market players will really be able to decide what the overall market expectation should be?
Right. So, Kamal, first of all, we have to admit that there is some wisdom in crowd. So market is a self-cleaning mechanism, wherein whenever there is any asset class which is getting a lot of attention or getting overvalued, it will fall. And anything which is getting no attention will eventually rise. That is how market works. And our job as an investor is not to pinpoint and see that which kind of investors will move the market and all. No. So there is a famous saying by the famous investor Rakesh Jhunjhunwala, wherein there are no kings in the market. Market is the king, right? So no particular set of investor decides the earnings expectation. Earning expectation is always a sum total of all the investors. So that is how it makes investing in markets so mysterious and so interesting. If it was so clear, you would just simply follow those investors, and everybody would follow those investors. And then again, these kind of divergence will never be there, right? So right now, you cannot be sure about what will happen in case of FMCG or the cyclical businesses. We are sharing just one of our views. That doesn't mean that we know that what is going to happen. It can happen that FMCG continues to do well over the next 2-3 years, and cyclicals disappoint in the next 2-3 years. Nobody knows for clarity. What you have to do as an investor, you have to have an independent view and try to see where are the inefficiencies, where you see that you can spot something and that is where your understanding of the business matters far more than your macro analysis or understanding about the cycles and all. If you understand one particular business, really well, you will be in a much better position compared to other investors. And all you have to do is find some 15-20 such businesses. You don't have to bet on all the businesses, right?
Next question is from Deepu Bhai. Can we look at ITC as a fixed deposit with a dividend yield and possible upside?
Yeah, very good question. And ITC, unfortunately, has been in the news for all the wrong reasons. People make fun of the stock, make memes and all, memes and all. But our view is that we don't want to make any recommendation here. But in terms of as an investor, if you buy ITC, you will buy ITC by believing, we have already covered that in the presentation also, where you believe that, as you rightly said, Deepak bhai, that you see limited downside in terms of the dividend yield which the stock is providing. And it is not just the dividend yield. See, again, if you take the example of Coal India, it has been giving a high dividend yield for so many years, right? But still the total return of an investor over the 5 years have been abysmal. In case of ITC, you can look at dividend yield positively because you can see the cash flows over the next 2-3 years, 5-year period from the cigarette business continue to grow, right? So whether as an investor you are fine with a fixed deposit with a dividend yield possible upside, or you want more growth, that is a personal question you have to ask yourself. So if you are a growth investor, you would probably not look at ITC today, because ITC may take some time to grow the earnings. And when you see that growth in earnings happening, then it is a better time for you to bet on the ITC stock. But if you are a conservative investor, where what you are looking at is a very clear downside limit and possible upside and a good dividend yield, ITC is a good stock for you.
Yeah,
So,
next question, Ankit. PFC is a financing company. Just a second. PFC is a financing company, hence debt equity may not be appropriate.
No, so Rudra, good question. So PFC is a financing company, and appropriate means whether you are a financing company or any operating company, if you are a company which has a debt equity ratio of 10:1 or 11:1, there is no denying the fact that your business model is far more fragile than any other company, irrespective of whatever industry that company is in. If you compare a debt-ridden company with a debt-free company, you should be willing to understand that a finance company which is having a 10:1 ratio of debt equity is a fragile business. If for some reason they are not being able to earn enough, they will have survival issues, right? So I don't know whether I could understand your question properly or not. So I said that in the example that it is not an apple-to-apple comparison, because we compared PFC with CRISIL, which was a credit rating company, right? But the point we were trying to put over there was that a debt-free company will always have a better P ratio, will be commanding a better P ratio compared to a debt-ridden company, right?
Yeah, next question is from Amol again.
Amol.
Negative working capital like FMCG have any direct or indirect effect on P?
Yeah, very good question, Amol. It does. It actually has a lot of effect in the, I would not say direct, but indirect effect on P, because ultimately P is a shortcut formula for the DCF, the way we calculate the discounted cash flow of a business. So any business which is having a large negative working capital, like you have said about FMCG, most FMCG business work on negative working capital. That itself says that that business year on year produces large amount of cash flows. So when a company is producing, because of negative working capital, they are producing more cash flows year on year, and it is consistently increasing, it will definitely increase the value of the company, intrinsic value of the company, and that will indirectly reflect in the P ratio as well over a period of time, right?
Yeah.
Amol, next question is just a thought: due to technological or social disruption, some companies might go out of business and stronger companies might take that market share and hence command higher P. Yes, that can completely happen. A very good example today is if you look at the large cap IT space and the mid cap IT space. So a stock like Infosys and TCS is trading at a much lesser PE ratio compared to so many mid-cap IT stocks. So that doesn't mean that Infosys or TCS are going out of business because of social disruption, but because market today is valuing these mid-cap IT companies far more than the other companies, the large ones, because they see probably these companies will grow at a much faster rate compared to a TCS or an Infosys. Whether that expectation is right or wrong, that only time will tell. But the divergence in the P ratio of large cap IT stocks and mid cap IT stocks clearly suggests that. That's a very good question, Amul.
Yeah, I think next question is from Rudra regarding how he can get the details about our first ROE class. So we will share that.
Yeah, we can share the link. Rudra, you can just contact us through WhatsApp or email, and we'll share with you the link, and you will get that ROE class recording.
Yeah, I think Yogesh has another question. How to track earning by much percentage it should grow? How much percentage it should grow? Q on Q or year on year? Rather than looking to past earning, we need to focus on future earning, right?
Yeah, good point, Yogesh. So whatever we see in screeners does a very good job of giving us past data, but earnings in the future cannot be projected just based on screeners or on the past data, because businesses change and situations change, environment change. Whether those earnings will continue to grow is something like, again, if you look at a few say sugar companies or ethanol companies today, they may see a bump up in earnings in the near term, which was not there at all in the last 3, 4, 5 years. So if you would have based your decision only based on the last 3, 4 years, you would assume that the sugar companies will not do well. Now, another thing is, if these sugar companies continue to do well for the next 3, 4, 5 years, and earnings growth continues to be really healthy, it is foolish to believe that, okay, it will continue forever. You have to keep on seeing that this is a cyclical business, which may become a secular business with the point of ethanol coming in. But today it is too early to say about that. Whether that happens or not, we have to keep on evaluating. And the question of whether Q on Q or year on year, it depends upon situation to situation. Like right now, when we are dealing with this pandemic, it is better to look at Q on Q, because if you look at year on year, last year we were in a different situation, and today we are in a completely different situation. What you need to see is a gradual improvement in the direction of the business, right? So today Q on Q would be much better, but generally a year on year growth is something which one should look at.
Yeah, another question from Yogesh.
So, sir, I just want to ask here, like, do we need to know about the percentage also? Like, should grow by 20%, EPS should grow by 20% every quarter on quarter, or like?
So, Yogesh, again, there is no thumb rule or there is no written rule about it. There are investors who build some screener and they want to basically make sure that until and unless they see a company earning, say, 10% or 15% earnings growth, they're not looking to look at those businesses, right? Then there are some investors who do not prepare screeners like that. They look at the businesses and they take a longer term view as to what these businesses are worth, whether these businesses are worth a lot more than what it is trading at today or not. If that is something which is happening, in those cases, it doesn't matter whether it is 10% earnings growth is 10%, 20%, or even if it is less than that. I hope I could answer this, Yogesh. So it is a personal decision whether you want to, what do you say, go by those 20% fixed rule of 20% or 30%. So our view is that if you have a very stringent rule of say 15 to 20%, you will probably miss out on some companies which will show you enough signs of future growth in the current activities, where the numbers may take some quarters to show up, right?
Yeah, I got it, your point, but let's say we are holding something already. Now we want to track its performance for the years. So how we should know like it's performing, like whether its EPS is going up to the mark or not?
So you don't analyze a company like that whether its CPS is 10% this year or not. What you look at is you look at the whole. The better way of looking at it is take a 3-year, 5-year rolling period. Like if you're analyzing a company today, or if you're holding a company today, due to pandemic or due to some reason in the last 1 year, it might be a case that the earnings might not have grown too high. But you take a 5-year view, then look at the 5-year rolling earnings, and then see whether the CAGR of the last 5 years is something which you have, which excites you or not, right? So 1 year earnings cannot be the basis of the investment. You have to take a longer term view if you are investing in a company.
Yeah, I think Yogesh had another question. Do companies forecast their future EPS in quarterly earning calls? Any website which shows future earnings or EPS?
So no company knows how much any company can make in the next quarter. So nobody can give you a sure shot guidance, right? But there are few companies who give a tentative guidance, like say sales growth of 10 to 15% or earnings growth of 10 to 20%. But your job as an investor or an analyst is not to take those comments at face value. You should also dig in and try to find out yourself whether that kind of growth in earnings or in sales, or in some cases they even talk about cash flow, is that possible or not. So any website cannot give you, any company cannot give you the future earnings. They can only give you their opinion. And ultimately, as an investor, you should also have your own independent opinion. So rather than looking for any website, you should probably listen to the con calls, read the con call transcript, and then try to use your own mind and figure out whether what management is saying is possible or not.
Yeah. Last question from Kamal again. Given that there will be earning growth, what are your views on PIG?
PEG is another ratio. So some investors look at PEG ratio, right? And they say that only will buy a stock which is at a PEG ratio of 1 or 2. But again, while there is some merit in this kind of a metric, but our view is that life and businesses are too uncertain to predict by any one metric. So agar this year the P ratio is the PEG ratio is higher, or so basically the P is higher than the growth which you are looking for that stock, doesn't mean that you will sell that stock. You can still hold on to those to that stock if in the long run you still believe. So ultimately, to cut these things short, you have to take a long-term view. If you focus on a PEG ratio or on a PE ratio of the current earnings or on the current year, you are going to miss the big picture. And your job as an investor is always to look at the big picture and see whether you are seeing the growth happening in that company or not. And if you really want to, so a very good question to ask yourself is, are you an investor who wants to hold on to great businesses or good businesses, or you are an investor who wants to be very active and keep on buying and selling businesses. If you are an investor who is an active one, you have to do two things right. You have to be able to anticipate or spot really undervalued companies, and then you should be equally be good at selling them at the right time. That is one way of investing. But if you are on the other side where you want to be a long-term partner of those companies, think as if it is your own business and look to own it till the time you see the business and the management performing. It is far, far, far important for you to look at the earning trajectory over the next 2-3 years, 5 years. People say 10 years, 20 years, but in this kind of a world, it is completely impossible to project earnings for say 10 years. So 3-year rolling basis, if you can just make a rough calculation, whether you see the earnings growing from here, whether you see the business doing. So ultimately, that is what matters more rather than having a PEG ratio or a PE ratio of this particular year. Good businesses will continue to trade at a higher valuation compared to average businesses. So basing your investment based on PEG ratio or PE ratio will have that kind of a problem.
Yeah, that's a very good thought process, Ankit. In fact, today only Kamal and all the participants, we actually put one tweet on SmartSync Services about what Swanand Kelkar, who was earlier the former managing director of Morgan Stanley, said. And I'll just quote that and read for all of you how it actually impacts our returns, future returns, as well as thought process in terms of how you can actually have an edge over the other investors, or you can get better returns. So he talks about the secret of superior returns, and he says that, the idea is very simple. There are 3 sources of superior returns: out knowing, out analyzing, and out behaving. When I say out knowing, that means I have more information than you. Whether that information is about P ratios, PEG or ROE or any other thing, I have more information than you. When I out analyze, that means I have analyzed the same information better than you. Means, you have done study in terms of annual reports, screeners, and other things, and you have actually gone through entire analysis. And then when I out behave you, it means with the same information and same analysis, I behave better than you in my investing process. And that is what Ankit is trying to show, that if you take a longer term approach in terms of holding that company, if the company is doing good, business is having good trajectory for future growth in future, you can actually benefit as an investor. So he says, as a conclusion, any superior long-term return will be 80% from out behaving, 15% from out analyzing, and if you really want to be charitable, only 5% from out knowing.
Right. Wonderful point, Akhilesh. So that is what we try to do at SmartSync Services. We are not in the game of being outsmarting other people or other investors in knowing more or over-analyzing it. We try to spend more time in minding our behavior and understanding what we can do and what we cannot do. So there are many things in the market and in the investing field which is doable and which is not doable. So understanding those things can actually help us in the long way. Thank you so much, everyone, for being a very patient listener for last 1.5 hours. And I hope you found some value out of it. We would just request, if you really found value in what we presented today, if you can just tag our Twitter handle and write a short testimonial. Only if you really feel that you found value in what we presented. That would do us a lot of good. Thank you so much, everyone. And we'll share the recording with all the participants in due course of time. Thank you. Thank you so much.
तो आशा करता हूं कि आपको ये वीडियो बहुत पसंद आया होगा। हमेशा की तरह आपसे एक ही विनती है कि अगर आपको इस वीडियो में वैल्यू लगा हो तो प्लीज अपने दोस्तों के साथ शेयर करिए, जिनको भी ये वीडियो देख के कुछ सीखने को मिल सकता है। और लाइक, शेयर एंड सब्सक्राइब करना ना भूलें। इसके साथ ही कमेंट्स में हमें जरूर बताएं कि आप और किस तरह के वीडियोस हमसे देखना चाहेंगे। इसके साथ ही मैं आपसे आज्ञा लूंगा। नमस्ते। थैंक यू।